Introduction, The Creative Investor's Journey. Welcome to The Creative Investor, How Commercial Real Estate Mirrors Stock Trading. This book is your guide to mastering two seemingly distinct fields that share a surprising number of parallels, commercial real estate and stock trading. On the surface, one deals with tangible properties while the other navigates abstract financial markets. However, at their core, both rely on the same blend of analytical rigor, creative thinking, and calculated risk-taking to unlock value and achieve lasting success. As investors, we often think of real estate and stocks as separate worlds, one dominated by bricks and mortar, the other by numbers and tickers. But the most successful investors know better. Both realms require an understanding of market dynamics, the ability to interpret key metrics, and, most importantly, the talent to see opportunities where others see obstacles. This book is about equipping you with the tools to bridge the gap between these two powerful investment strategies. Why real estate and stocks are two sides of the same coin. Whether you're acquiring a commercial property or trading shares of a technology company, the same fundamental questions arise. How do you measure value? In real estate, it's the capitalization, cap, rate. In stocks, it's the price to earnings, P, ratio. What drives growth? For properties, it could be economic development or population trends. For stocks, it's innovation or market expansion. How do you manage risk? Diversification and the market analysis play critical roles in both disciplines. These shared principles form the foundation of this book, which is structured to guide you through the intricacies of analysis, creativity, and execution. By comparing and contrasting the tools and strategies in each field, you'll gain a deeper understanding of how to make smarter, more informed decisions in both. What you'll learn. This book is more than just a guide, it's a toolkit for sharpening your analytical and creative skills. Here's a snapshot of what lies ahead. Chapter 1, The Analytical Foundation. Learn how numbers drive decisions in both real estate and stock markets, from calculating returns to spotting undervalued assets. Chapter 2, Creativity in Investment. Explore how innovation can add value, whether through property renovations or identifying disruptive companies in the stock market. Chapter 3, Understanding Financial Metrics. Master the key metrics, such as cap rates, ratios, and debt service coverage ratios, to quantify risks and rewards. Chapter 4, Market Dynamics. Discover the external forces, like local economic trends or global interest rates, that shape investment opportunities. Chapter 5, The Talent Factor. Uncover the balance between intuition and analysis, and how the best investors leverage both to stay ahead of the curve. Chapter 6, Portfolio Diversification. Learn strategies to mitigate risk by balancing assets across different sectors, geographies, and risk profiles. Chapter 7, Conclusion. Tie it all together by mastering the art of integrating creativity and analysis for sustainable success. Who this book is for? This book is for anyone looking to deepen their investment knowledge and expand their horizons, real estate investors seeking to diversify into stocks, stock traders curious about the stability and returns of commercial real estate, beginners who want a roadmap to navigate the complexities of both fields, seasoned investors aiming to refine their strategies with new insights and techniques. Whether you're managing a portfolio worth millions or just starting your investment journey, this book provides actionable insights tailored to your needs. The creative and analytical balance. Great investing is both a science and an art. The science lies in the metrics, formulas, and strategies that quantify risks and returns. The art lies in seeing the bigger picture, anticipating trends, identifying hidden potential, and acting with conviction. By mastering both, you'll transform from an average investor into a visionary one. As you turn these pages, remember that investing is more than a means to financial growth, though it's a way to create opportunities, build value, and leave a lasting impact. This book invites you to embrace both the creative and analytical aspects of investing, applying them to real estate and stocks alike. Let's begin this journey together, and unlock the tools to succeed in two of the most rewarding and dynamic investment landscapes. Page 1. Title, The Creative Investor, How Commercial Real Estate Mirrors Stock Trading. Table of Contents. 1. Introduction, The Intersection of Real Estate and Stock Trading. 2. The Analytical Foundation, Numbers that Drive Decisions. 3. Creativity in Investment, Adding Value to Properties and Portfolios. 4. Understanding Financial Metrics, Cap Rates, Ratios, and beyond. 5. Market Dynamics, Evaluating Growth Potential in Real Estate and Stocks. 6. The Talent Factor, Intuition Meets Analysis. 7. The Art of Portfolio Diversification, From Properties to Stocks. 8. Conclusion, Mastering the Creative and Analytical Balance. Chapter 1, Introduction. The intersection of real estate and stock trading. Investment is both an art and a science. Whether you're buying commercial real estate or trading stocks, the core principles are remarkably similar. This ebook explores these parallels, focusing on how analytical skills, creativity, and a deep understanding of financial and the market dynamics contribute to success in both fields. Chapter 2, The Analytical Foundation, Numbers that Drive Decisions. Numbers are the backbone of both stock trading and real estate investing. In stocks, investors look at metrics like the price-to-earnings ratio to assess a company's profitability. Similarly, in commercial real estate, the capitalization rate, cap rate, helps investors understand a property's income potential. Ratio versus cap rate. Ratio measures how much an investor pays for $1 of earnings. Cap rate measures a property's net operating income as a percentage of its purchase price. Mastering these metrics is crucial for identifying undervalued opportunities and making data-driven decisions. Chapter 3, Creativity in Investment, Adding Value to Properties and Portfolios. Creativity is often underestimated in investing, yet it plays a pivotal role. In commercial real estate, adding value might involve renovating or upgrading a property to increase rent potential. Rezoning to unlock new uses for a site. Introducing innovative tenant agreements to stabilize income streams. In stock trading, adding value might look like identifying companies with growth potential through innovation or disruptive market strategies. Chapter 4, Understanding Financial Metrics, Cap Rates, Ratios, and Beyond. Both stocks and real estate rely on financial metrics to quantify risk and reward. Cap rate determines return on investment. Debt Service Coverage Ratio, DSCR, evaluates a property's ability to cover its debt. Occupancy Rates assesses revenue stability in real estate. Earnings per share, EPS, reflects profitability in stocks. Investors must synthesize these numbers to see the bigger picture and anticipate long-term outcomes. Chapter 5, Market Dynamics, Evaluating Growth Potential in Real Estate and Stocks. Market dynamics influence both asset classes. Factors to consider include, for real estate, local population trends, economic development in the area, zoning regulations and tax policies. For stocks, industry growth rates, competitor analysis, macroeconomic indicators like interest rates and inflation. Both require investors to assess not just the current value but the potential for growth and stability. Chapter 6, The Talent Factor, Intuition Meets Analysis. Investment is as much about gut feeling as it is about data. Successful investors blend analytical skills to evaluate metrics, intuition to anticipate market shifts, creativity to see opportunities others overlook. Whether it's a young stockbroker picking Tesla early or a real estate investor spotting a revitalizing neighborhood, talent bridges the gap between analysis and action. Chapter 7, The Art of Portfolio Diversification, From Properties to Stocks. Diversification is key to mitigating risk. Strategies include balancing high-risk, high-reward investments with stable assets, diversifying by geography, industry, or property type, using financial tools like REITs, real estate investment trusts, to gain exposure to both stocks and real estate markets. Chapter 8, Conclusion, Mastering the Creative and Analytical Balance. The most successful investors understand that investing is both a science and an art. By mastering analytical tools, fostering creativity, and honing intuition, you can thrive in both commercial real estate and stock trading. Investing isn't just about making money, it's about creating opportunities and driving growth, one decision at a time. Downloadable resources, Glossary of Investment Terms. Quick reference guide to key metrics. Actionable tips for building a diversified portfolio. Page 2. Chapter 2, The Analytical Foundation, Numbers that Drive Decisions. In the world of investment, numbers tell the story. They illuminate opportunities, reveal risks, and guide decisions. Whether you're trading stocks or investing in commercial real estate, mastering the language of numbers is essential for success. It's not just about crunching figures but understanding the context and story they tell about an asset's potential. This chapter delves into the fundamental metrics like the price-to-earnings ratio in stocks and the capitalization cap rate in real estate that form the backbone of any analytical strategy. Ratio versus cap rate, two sides of the same coin. Both the ratio and cap rate are critical tools for evaluating investment opportunities. Despite their use in different domains, these metrics share a common purpose: they help investors quantify value and assess potential returns. Ratio, the price-to-earnings ratio, measures how much investors are willing to pay for every $1 of a company's earnings. It's calculated by dividing the market price per share by the earnings per share, EPS. A lower ratio may indicate that a stock is undervalued, while a higher ratio often signals investor confidence in the company's growth prospects. Example, if a company's stock price is $100 and its EPS is $10, the ratio is 10. This means investors are paying $10 for every dollar the company earns. Cap rate, the capitalization rate, measures the return on a real estate investment, calculated as the net operating income, NOI, divided by the property's purchase price. A higher cap rate suggests higher potential returns, though it may also indicate higher risk. Example, if a property generates $100,000 in NOI and was purchased for $1 million, the cap rate is 10%. This means the investor is earning 10% annually on their investment before considering financing costs. Both metrics provide a snapshot of an asset's value and profitability, allowing investors to make informed decisions. Why these metrics matter: understanding the ratio and cap rate is crucial for identifying undervalued opportunities and making data-driven choices. However, their usefulness goes beyond mere numbers. They reflect broader market dynamics and help gauge risk and reward. Value assessment. In stocks, a low ratio might indicate a bargain, but it could also signal underlying issues with the company. Similarly, a property with a high cap rate might yield strong income but could be in a less desirable location, requiring further analysis. Market comparison. Both metrics allow investors to compare options within the same category. A ratio can be used to evaluate companies in the same industry, while a cap rate helps compare properties in similar markets or asset classes. Risk insight. High ratios often suggest a stock is priced for growth, which may involve higher risk. In real estate, a low cap rate could indicate a stable but low-yielding investment, such as a fully leased property in a prime location. Beyond the basics, context matters. While these metrics provide a strong foundation, their true value lies in how they are interpreted within the context of broader market conditions. Numbers must be considered alongside qualitative factors like management quality in a company or neighborhood trends in real estate. Stock trading context. A tech company with a high ratio might seem overvalued, but if it operates in an emerging sector with strong growth potential, the ratio could be justified. Conversely, a low ratio in a struggling industry might signal a value trap. Real estate context. A property with a 12% cap rate might appear lucrative, but if it's located in an economically declining area, the risks may outweigh the rewards. On the other hand, a property with a 5% cap rate in a high-demand urban center might be a safer long-term bet. The interplay of metrics in decision-making. Just as a successful stock trader looks at multiple financial ratios, for example, PEG, ROE, a seasoned real estate investor considers additional metrics like cash-on-cash return, debt service coverage ratio, DSCR, and internal rate of return, IRR. These numbers work together to create a fuller picture of an investment's potential. Developing an analytical edge. Numbers alone don't make a successful investor. The ability to interpret data, identify trends, and act decisively separates the good from the great. This requires data mastery. Learn how to calculate and interpret key metrics. Stay updated on industry standards and benchmarks for ratios and cap rates. Market awareness. Understand the factors influencing numbers, such as interest rates, economic cycles, and industry trends. Pay attention to external conditions like policy changes, technological innovations, or demographic shifts. Practical application. Apply metrics to real-world scenarios through case studies, simulations, or small-scale investments. Review historical data to understand how these metrics have behaved during market highs and lows. Conclusion. Numbers are the compass guiding investors through the complex landscape of commercial real estate and stock trading. Metrics like the ratio and cap rate provide clarity, helping investors evaluate opportunities, compare risks, and make informed decisions. However, the story doesn't end with numbers. Understanding their context and integrating them into a broader investment strategy is where analytical foundations transform into actionable insights. As you sharpen your skills in interpreting these key metrics, you'll build the confidence and precision needed to thrive in both worlds. Page 3. Chapter 3, Creativity in Investment, Adding Value to Properties and Portfolios. Investment isn't solely about numbers and metrics, it's also an exercise in creativity. While the analytical side of investing provides the foundation, creativity is the spark that turns potential into profit. Both commercial real estate and stock trading demand innovative thinking to add value, whether by enhancing a property's income potential or identifying stocks poised for growth. This chapter explores how creative strategies can transform ordinary investments into extraordinary opportunities. The role of creativity in investment. Creativity in investment is about envisioning what could be, not just what is. It involves thinking outside the box, identifying untapped opportunities, and finding ways to maximize returns. In commercial real estate, creativity can mean unlocking a property's hidden potential. In stock trading, it involves spotting trends, recognizing disruptive innovations, and aligning with companies poised for explosive growth. The common thread is value creation, which is the ultimate goal of any successful investment. Adding value. In commercial real estate, renovating or upgrading properties. Renovations are one of the most straightforward ways to increase a property's value. Upgrading outdated facilities, improving energy efficiency, or modernizing common areas can attract higher-paying tenants and increase overall rental income. Example, a commercial office building with a dated lobby and inefficient HVAC system can see significant value appreciation after renovations. Higher rents and lower operating costs lead to improved net operating income, NOI, boosting the property's overall worth. Rezoning for new uses. Creative investors look beyond current zoning restrictions to explore potential rezoning opportunities. Rezoning can transform a single-use property into a mixed-use development or convert an underutilized warehouse into a trendy retail space. Example, a vacant industrial property near a growing residential area might be rezoned to allow for a grocery store or entertainment complex, significantly increasing its market appeal and profitability. Innovative tenant agreements. Stable and predictable income streams are critical in commercial real estate. Offering flexible lease terms, profit-sharing agreements, or co-branding opportunities can attract tenants with strong potential for long-term success. Example, partnering with a startup for a revenue-sharing lease agreement allows the investor to share in the tenant's success while securing occupancy in a competitive market. Adding value in stock trading. Spotting companies with growth potential. Creative stock traders excel at identifying companies that are on the verge of major growth. This could involve tracking industries poised for disruption, such as renewable energy, AI, or healthcare innovation. Example, a trader might identify a small biotech firm with a promising drug in its pipeline and invest early, anticipating approval that could multiply the stock's value. Understanding market disruptors. Disruptive companies change the rules of the game. Recognizing these shifts early requires creative thinking and a willingness to challenge conventional wisdom. Example, investors who saw the potential of ride-sharing apps like Uber early on understood that they weren't just investing in transportation, they were investing in a complete reimagining of urban mobility. Value-added analysis. Traders often add value by combining traditional metrics with forward-looking insights. For instance, they might pair financial ratios with qualitative factors like management expertise or brand loyalty. Example, a company with average financials but a highly respected CEO might be a strong investment due to leadership's potential to drive future innovation and profitability. Parallels between real estate and stocks. Both fields rely on creativity to create or recognize value, but the methods differ slightly. Commercial real estate, creativity is tangible, involving physical improvements, zoning changes, and innovative tenant strategies. Stock trading, creativity is intangible, relying on foresight, pattern recognition, and the ability to capitalize on market trends. Despite these differences, the underlying principle is the same, to identify ways to transform an investment into something more valuable. Examples of creative investments. The case of a revitalized retail space. An investor purchases a struggling strip mall in a suburban area. By adding a co-working space, introducing pop-up retail options, and hosting community events, the property becomes a vibrant local hub. Rents increase, occupancy stabilizes, and the property's value soars. A tech stock with hidden potential. A stock trader notices an underperforming tech company investing heavily in AI research. By analyzing the potential applications of their innovation, the trader anticipates a market breakthrough. When the company announces a revolutionary AI product, the stock's value doubles. Balancing creativity with risk. Creative investment is not without its risks. Renovations can go over budget, rezoning efforts might face regulatory hurdles, and speculative stock plays could fail to materialize. Successful investors weigh the potential rewards against these risks, employing strategic thinking and careful planning. Fostering creativity in investment. Stay informed, regularly explore market trends, emerging technologies, and policy changes to identify opportunities others might overlook. Think holistically, consider how various factors such as demographics, industry shifts, and economic cycles impact your investments. Collaborate and network, engage with experts in related fields to gain fresh perspectives and spark innovative ideas. Experiment on a small scale, test creative strategies in lower-stakes scenarios before committing significant resources. Conclusion. Creativity in investment is about more than just thinking differently, it's about thinking smartly. Whether you're unlocking the potential of a physical property or spotting the next big trend in the stock market, creative strategies drive success. By embracing innovation and daring to see value where others might not, investors can achieve exceptional returns while transforming their portfolios into engines of growth. Page 4. Chapter 4, Understanding Financial Metrics, Cap Rates, Ratios, and Beyond. Investment success often hinges on understanding and interpreting financial metrics. Whether you're analyzing commercial real estate or evaluating a stock, these metrics serve as critical tools for quantifying risk and predicting rewards. Each metric provides a piece of the puzzle, and when synthesized, they form a comprehensive picture of an investment's potential. This chapter explores the most important financial metrics in both real estate and stock trading, with a focus on their practical application and strategic significance. The importance of financial metrics. Metrics act as the language of investment. They translate the complex dynamics of markets, properties, and businesses into measurable data points. For both real estate and stock investments, mastering these metrics enables investors to quantify risk, understand the potential downside of an investment, Project returns, estimate the financial benefits of a deal. Compare options, evaluate competing opportunities using standardized measures. Guide strategy, develop data-driven plans for growth and value creation. Key metrics in commercial real estate: cap rate, capitalization rate. Definition: the cap rate is the ratio of a property's net operating income, NOI, to its purchase price. It measures the return on investment, ROI, based on income generated. Formula: the capitalization rate, commonly known as cap rate, is calculated by dividing the net operating income, NOI, by the property purchase price, and then multiplying the result by 100 to express it as a percentage. In other words, cap rate equals net operating income divided by property purchase price, with the result multiplied by 100. To break it down further, first, determine the net operating income, NOI, of the property. This is the annual income generated by the property after deducting all operating expenses, but before mortgage payments and income taxes. Next, identify the property purchase price, which is the total cost to acquire the property. Divide the net operating income by the property purchase price. Finally, multiply the resulting number by 100 to convert it to a percentage. The final percentage represents the cap rate, which indicates the rate of return on the property investment based on the income it generates relative to its purchase price. Use: a high cap rate suggests a higher ROI but may indicate higher risk. Conversely, a low cap rate often reflects stability and lower risk. Example: if a property generates $100,000 in annual NOI and costs $1 million, the cap rate is 10%. Debt Service Coverage Ratio, DSCR. Definition: DSCR measures a property's ability to cover its debt obligations from its operating income. Formula: the Debt Service Coverage Ratio, commonly abbreviated as DSCR, is calculated by dividing the net operating income, NOI, by the total debt service. In other words, DSCR equals net operating income divided by total debt service. To break it down further, first, determine the net operating income, NOI, of the property. This is the annual income generated by the property after deducting all operating expenses, but before mortgage payments and income taxes. Next, calculate the total debt service, which is the total amount of mortgage payments, principal and interest, required to be paid over a given period, typically annually. Divide the net operating income by the total debt service. The resulting number represents the DSCR, which indicates how well the property's income covers its debt obligations. A DSCR of 1.0 means the property's income exactly covers its debt payments, while a higher number indicates small cushion and a lower number suggests potential difficulty in meeting debt obligations. Use: a DSCR above 1 indicates that the property generates sufficient income to cover its debt, while a DSCR below 1 signals financial vulnerability. Example: a property with $120,000 NOI and $100,000 annual debt service has a DSCR of 1.2, suggesting a healthy financial position. Occupancy rate. Definition: the percentage of leased or occupied units in a property. Formula: the occupancy rate is calculated by dividing the number of occupied units by the total units, and then multiplying the result by 100 to express it as a percentage. In other words, the occupancy rate equals the number of occupied units divided by the total units, with the result multiplied by 100. To break it down further, first, determine the total units available in the property. This includes all residential or commercial units that can be rented or leased. Next, count the number of occupied units, which are the units that are currently rented or leased to tenants. Divide the number of occupied units by the total units. Finally, multiply the resulting fraction by 100 to convert it to a percentage. The final percentage represents the occupancy rate, indicating how much of the available space is currently occupied. A higher occupancy rate generally suggests better performance for a property, while a lower rate may indicate vacancies and potential revenue loss. Use: higher occupancy rates indicate revenue stability and lower risk. Example: an apartment complex with 90 out of 100 units rented has a 90% occupancy rate. Key metrics in stock trading: price to earnings, P ratio. Definition: the ratio measures how much an investor is willing to pay for $1 of a company's earnings. Formula: the price to earnings ratio, commonly known as the P/E ratio, is calculated by dividing the market price per share by the earnings per share, EPS. In other words, the P/E ratio equals the market price per share divided by the earnings per share. To break it down further, first, determine the market price per share. This is the current trading price of a single share of the company's stock in the market. Next, identify the earnings per share, EPS. This is the company's net profit divided by the number of outstanding shares, typically calculated for the last 12 months or projected for the next 12 months. Divide the market price per share by the earnings per share. The resulting number represents the P/E ratio, which indicates how much investors are willing to pay for each dollar of earnings. A higher P/E E ratio suggests that investors expect higher earnings growth in the future compared to companies with a lower P/E ratio. This ratio is commonly used to assess whether a stock is overvalued or undervalued relative to its earnings and in comparison to other companies or the overall market. Use: a high P ratio suggests optimism about future growth, while a low P ratio may signal undervaluation or financial risk. Example: if a stock trades at $50 per share and earns $5 per share annually, its P ratio is 10. Earnings per share, EPS. Definition: EPS reflects a company's profitability by dividing net income by the total number of outstanding shares. Formula: earnings per share, commonly abbreviated as EPS, is calculated by dividing the net income by the number of outstanding shares. In other words, EPS equals net income divided by the number of outstanding shares. To break it down further, first, determine the net income of the company. This is the total profit the company has earned over a specific period, typically a quarter or a year, after deducting all expenses, taxes, and preferred dividends. Next, identify the number of outstanding shares. This is the total number of shares of the company's stock that are currently held by all its shareholders, including company insiders, institutional investors, and the public. Divide the net income by the number of outstanding shares. The resulting number represents the earnings per share, which indicates how much profit the company has generated for each outstanding share of its stock. EPS is a key metric used by investors to assess a company's profitability on a per-share basis and is often used in calculating other financial ratios, such as the price-to-earnings P/E ratio. Use: higher EPS indicates greater profitability and financial health. Example: a company with $1 million in net income and 500,000 shares outstanding has an EPS of $2. Dividend yield. Definition: the dividend yield measures the income return on a stock investment. Formula: the dividend yield is calculated by dividing the annual dividend per share by the market price per share, and then multiplying the result by 100 to express it as a percentage. In other words, dividend yield equals annual dividend per share divided by market price per share, with the result multiplied by 100. To break it down further, first, determine the annual dividend per share. This is the total amount of dividends paid out by the company per share over a year. If dividends are paid quarterly, you would sum up the 4 quarterly dividends to get the annual amount. Next, identify the market price per share. This is the current trading price of a single share of the company's stock in the market. Divide the annual dividend per share by the market price per share. Finally, multiply the resulting number by 100 to convert it to a percentage. The final percentage represents the dividend yield, which indicates the annual return on investment, expressed as a percentage, that a shareholder can expect to receive in the form of dividends, based on the current market price of the stock. This metric is often used by income-focused investors to compare the relative attractiveness of different dividend-paying stocks or to compare stocks against other income-generating investments. Use: a higher yield is attractive for income-focused investors but may indicate a slower-growing company. Example: a stock with a $2 annual dividend and a $50 price per share has a dividend yield of 4%. Synthesis: seeing the bigger picture. While each metric provides valuable insights, the true power lies in synthesizing them to gain a holistic view of an investment. For example, a high cap rate property with a low DSCR might indicate strong income potential but significant financial risk. A low ratio stock with rising EPS could suggest a hidden growth opportunity. Investors must look beyond individual metrics, considering factors such as market conditions, growth trajectories, and external risks. The table compares 3 key metrics used in real estate investing with their equivalent metrics in stock trading. Profitability measure: in real estate, the net operating income, NOI, is used as a measure of profitability. This is equivalent to earnings per share, EPS, in stock trading. Both metrics provide insight into the income-generating potential of the investment. Valuation and return on investment, ROI, indicator: for real estate, the capitalization rate, cap rate, serves as a valuation and ROI indicator. In stock trading, the price-to-earnings, P ratio fulfills a similar role. These metrics help investors assess the value of their investment relative to its income or earnings. Income stability: in real estate, the occupancy rate is used to gauge income stability. This is comparable to the dividend yield in stock trading. Both metrics provide information about the consistency and reliability of income from the investment. These comparisons highlight how similar concepts are applied across different investment types, allowing investors to evaluate and compare opportunities in both real estate and stock markets using familiar frameworks. Practical application case study: mixed-use property investment scenario. A mixed-use property offers a cap rate of 8% and a DSCR of 1.5. It has an occupancy rate of 85%. Analysis: the property provides strong income potential and financial stability, but there may be opportunities to increase occupancy for even greater returns. Case study, growth stock analysis scenario. A tech stock has a P/E ratio of 15, EPS growth of 10% annually, and a dividend yield of 2%. Analysis, the stock offers a reasonable valuation with solid growth potential and a steady income stream, making it a balanced choice for a diversified portfolio. Conclusion: financial metrics are the compass guiding investors through the complexities of real estate and stock markets. By mastering these tools and understanding their interplay, investors can make informed decisions that align with their financial goals. Whether assessing cap rates or ratios, the ability to synthesize data into actionable insights is the hallmark of a successful investor. Page 5. Chapter 5, Market Dynamics, Evaluating Growth Potential in Real Estate and Stocks. Market dynamics are the unseen forces that influence the potential growth and profitability of investments, whether in real estate or stocks. Successful investors must analyze and anticipate these dynamics to make informed decisions, recognizing that today's value is only part of the story. The real key lies in the potential for tomorrow's growth and stability. In this chapter, we'll explore the critical market factors that shape investment opportunities, contrasting the nuances of real estate and stocks while highlighting the common analytical frameworks that apply to both. Understanding market dynamics. Market dynamics refer to the broader conditions that affect supply, demand, and value in any given market. They encompass economic, social, regulatory, and technological trends, and they directly impact the growth potential of both real estate and stocks. Investors who can read these dynamics effectively position themselves to capitalize on opportunities and mitigate risks. Market dynamics in real estate. When evaluating commercial real estate, market dynamics often center on location, demographics, and local policies. Key factors include local population trends. What to look for: population growth in a region often correlates with increased demand for commercial and residential spaces. Conversely, declining populations may signal oversupply and stagnant trends. Example, a city experiencing a tech boom might see an influx of young professionals, increasing demand for office spaces and urban apartments. Economic development. What to look for: new infrastructure projects, such as highways, public transit systems, or business parks, can significantly enhance property values. Example, a warehouse located near a newly constructed shipping port is likely to see increased demand and higher rents. Zoning regulations and tax policies. What to look for: changes in zoning laws can unlock new uses for a property, such as converting industrial spaces to residential or mixed-use developments. Favorable tax incentives for specific types of businesses can also drive demand. Example, rezoning a property from commercial to mixed-use might allow for the addition of residential units, increasing its income potential. Market dynamics in stock trading. The stock market is influenced by a mix of company-specific and macroeconomic factors. Key considerations include industry growth rates. What to look for: industries experiencing rapid growth, such as renewable energy or artificial intelligence, often present lucrative opportunities for investors. Understanding the life cycle stage of an industry, or whether it is emerging, maturing, or declining, is crucial. Example, investing in an electric vehicle manufacturer during the early stages of market adoption can yield significant returns if the industry continues to expand. Competitor analysis. What to look for: companies that maintain a competitive edge through innovation, cost leadership, or market dominance are more likely to succeed. Tracking the strategies and performance of competitors provides insight into a company's long-term viability. Example, a software company with a growing market share and a robust patent portfolio may outperform rivals, making it an attractive investment. Macroeconomic indicators. What to look for: interest rates, inflation, and GDP growth significantly impact stock market performance. Rising interest rates often reduce borrowing capacity for companies, while inflation can erode consumer spending power. Example, during periods of high inflation, stocks in consumer staples such as food or healthcare tend to perform better as demand for these goods remains steady. This table compares 5 key factors that influence market dynamics in real estate and stocks, highlighting the different focus areas for each investment type. Population trends. In real estate, the focus is on regional and urban population growth. This directly impacts housing demand and property values in specific areas. For the stock market, the focus is on broader demographic shifts that affect entire industries, such as aging populations influencing healthcare stocks. Economic development. Real estate is particularly concerned with local infrastructure projects, which can significantly enhance property values in an area. In contrast, the stock market focuses on industry-wide growth and innovation, which can boost the performance of entire sectors or individual companies. Regulation and policy. For real estate, zoning laws and tax incentives play a crucial role in shaping market dynamics. These can affect property development and investment decisions. In the stock market, government regulations and trade policies have a broader impact, influencing the operational environment for various industries. Competition. In real estate, the focus is on local market saturation, which can affect property values and rental rates in specific areas. For stocks, competition is viewed in terms of rivalry among industry leaders, which can impact market share and profitability of individual companies. Macroeconomic conditions. Real estate is particularly sensitive to interest rates, as these affect borrowing costs for property purchases and development. In the stock market, broader economic indicators such as inflation and GDP growth are closely watched, as they can influence corporate earnings across various sectors. This comparison illustrates how real estate and stock investments are influenced by different, though sometimes overlapping, market dynamics. Understanding these distinctions can help investors make more informed decisions in each market. Evaluating growth potential. The bigger picture successful investing requires looking beyond surface-level data to anticipate future changes in market conditions. Both real estate and stocks require careful consideration of supply and demand balance. Real estate. Is there an oversupply of office spaces in the city? Are there barriers to new construction that limit supply? Stocks. Is the company operating in a saturated market, or does it have room to grow by capturing new customers? External risks and opportunities. Real estate. How will climate change affect the long-term value of a coastal property? Stocks. How might a new government policy impact the profitability of the renewable energy sector? Long-term stability versus short-term gains. Real estate. Does the property provide stable rental income even during economic downturns? Stocks. Is the company's growth sustainable, or is it driven by temporary market trends? Case studies. Real estate case study. Suburban retail center. A suburban retail center located near a planned residential development experiences rising demand. By analyzing population growth and future infrastructure projects, an investor identifies the potential for a significant increase in property value over 5 years. Stock market case study. Biotechnology company. A biotech firm developing innovative therapies gains attention due to increased government funding for healthcare research. An investor evaluates the company's competitive position, industry growth rates, and regulatory environment to project its potential for long-term success. Conclusion. Evaluating market dynamics is both a science and an art. It requires not only analyzing existing data but also anticipating future changes that could shape an investment's trajectory. Whether you're assessing a commercial property's growth potential or the future profitability of a stock, understanding market dynamics enables you to make informed, strategic decisions. Mastery of this process separates good investors from great ones, making it an indispensable skill for long-term success. Page 6. Chapter 6, The Talent Factor, Intuition Meets Analysis. When it comes to investing, whether in stocks or commercial real estate, success often hinges on a unique combination of skills that blend hard data with something less tangible, intuition. Numbers and metrics provide a foundation for decision-making, but the ability to sense opportunities before they fully materialize is what sets exceptional investors apart. Talent bridges this gap between analysis and action, turning raw data into strategic decisions that lead to remarkable outcomes. This chapter delves into the critical role of talent in investment, focusing on how analytical skills, intuition, and creativity work together to navigate complex markets. Talent. The X factor in investment. Investment talent is the ability to synthesize vast amounts of information, filter out noise, and make confident decisions. It isn't purely analytical nor solely instinctive, it's a nuanced blend of both. While education and experience can hone an investor's abilities, a certain natural flair often separates the merely competent from the truly outstanding. Consider 2 scenarios. The young stockbroker. A 25-year-old stockbroker identifies Tesla as a promising investment in its early days. The decision isn't based solely on financial reports but also on an understanding of emerging trends in technology, a belief in the potential of electric vehicles, and confidence in Elon Musk's leadership. The real estate visionary. A seasoned real estate investor sees promise in a declining urban neighborhood. While crime rates are high and current rents are low, the investor notices key signals in new infrastructure projects, an influx of young professionals, and upcoming zoning changes. Acting on intuition backed by data, they secure properties before the neighborhood revitalizes. Both examples demonstrate how talent combines analytical rigor with gut feeling to achieve extraordinary results. The role of analytical skills. Strong analytical skills are the foundation of successful investing. In both stocks and real estate, talent often starts with the ability to dissect numbers and identify trends. Here's how. Understanding financial metrics. In stocks, investors rely on data like price-to-earnings ratios, earnings per share, EPS, and revenue growth rates. In real estate, metrics such as capitalization rates, cap rates, net operating income, NOI, and debt service coverage ratios, DSCR, are essential for evaluating properties. Spotting patterns in data. Successful investors don't just look at raw numbers, they find patterns. For example, a stock's price movement over time may indicate market sentiment, while real estate vacancy rates could signal shifting demand. Risk assessment. Talent includes the ability to weigh risks against rewards. Whether it's determining if a stock is overvalued or assessing a property's exposure to market downturns, strong analytical skills are essential for mitigating losses. Intuition, the gut feeling that drives bold moves. If analysis is the engine of investment, intuition is the steering wheel. Intuition helps investors navigate uncertain markets, anticipate trends, and act decisively when opportunities arise. Market shifts and trends. Intuitive investors often sense market changes before they are reflected in metrics. For example, a stock trader might notice growing consumer interest in sustainable products and invest in companies leading the charge. Similarly, a real estate investor might sense an undervalued market based on subtle cultural or economic shifts. Timing, knowing when to buy or sell, is often a matter of intuition. Analytical tools can provide guidance, but there's no substitute for the instincts honed by experience. Risk appetite. Talented investors understand their own risk tolerance and can intuitively gauge whether an opportunity aligns with it. This self-awareness is a critical aspect of talent. Creativity. Seeing what others miss. Creativity in investment involves envisioning opportunities others might overlook. It's about looking beyond the obvious and considering innovative ways to add value. Adding value to real estate renovations, rezoning, and strategic tenant placement are just a few ways to enhance a property's profitability. Creative investors think outside the box, seeing potential where others see problems. Finding hidden gems in stocks. In the stock market, creativity might mean identifying small-cap companies with disruptive technologies or investing in industries on the brink of transformation. Creating synergies. Talented investors often see connections others don't. For example, a real estate investor might purchase a portfolio of properties to create economies of scale, while a stock investor might diversify into industries that complement each other. The talent ecosystem, where intuition, analysis, and creativity meet. Talent isn't confined to one aspect of investing, it's the intersection of intuition, analytical rigor, and creativity. This combination allows investors to recognize undervalued opportunities before they're widely acknowledged. Take calculated risks based on both numbers and instinct. Innovate in ways that maximize returns while mitigating risks. Cultivating talent, can it be taught? While talent often has an innate component, it can also be developed through deliberate practice. Ways to cultivate talent include continuous learning. Staying informed about market trends, new technologies, and economic shifts builds both analytical and intuitive skills. Experience. There's no substitute for time spent in the market. Every decision of whether a win or a loss adds to an investor's toolkit. Mentorship. Learning from seasoned investors helps accelerate the development of intuition and creativity. Reflection. Reviewing past decisions critically enhances self-awareness and refines one's investment approach. Conclusion. Talent as the ultimate differentiator. In the world of investment, talent is the ultimate differentiator. It's what enables some investors to consistently outperform the market, whether they're trading stocks or acquiring real estate. The interplay of intuition, analysis, and creativity isn't just a skill, it's an art form that transforms ordinary opportunities into extraordinary results. By honing this talent, you can bridge the gap between data and action, turning potential into profit. Page 7. Chapter 7, The Art of Portfolio Diversification. From properties to stocks, diversification is the golden rule of investing. Whether you're building a portfolio of stocks or acquiring commercial real estate properties, the ability to spread risk while maximizing potential returns is a critical skill. Diversification ensures that no single investment decision can derail your financial goals, making it a cornerstone of successful portfolio management. In this chapter, we'll explore the principles of diversification, highlight strategies for balancing risk and reward, and show how diversification spans both the stock market and real estate investments. Why diversification matters. The goal of diversification is simple: to reduce risk. When a portfolio is heavily concentrated in a single asset, sector, or market, it becomes vulnerable to the unique risks associated with that category. Diversification minimizes these vulnerabilities by spreading investments across various assets with different risk profiles, thus ensuring stability and resilience. For instance, in stocks, a portfolio heavily weighted in technology stocks might experience sharp losses during a tech downturn. Adding investments in healthcare, energy, or consumer goods can buffer against such sector-specific volatility. In real estate, owning properties in a single city exposes an investor to risks like local economic downturns or policy changes. Diversifying across multiple regions reduces this risk and ensures more stable returns. Strategies for diversification. Balancing risk and reward. Every portfolio needs a mix of higher risk, higher reward investments and stable, low-risk assets. In stocks, growth stocks, like emerging tech companies, are higher risk but offer significant upside, while blue-chip stocks provide stability and steady dividends. In real estate, a high-risk investment might involve purchasing a property in an emerging market, while a stable investment could be acquiring a well-established commercial property with long-term tenants. Geographical diversification. Both stocks and real estate are subject to geographic risks, such as regional economic conditions, natural disasters, or regulatory changes. For stocks, this means investing in companies across different countries or regions. For example, balancing US tech stocks with European industrials or Asian financial firms. For real estate, owning properties in various cities or even countries reduces reliance on a single market's performance. Industry or property type diversification. Diversification across industries or property types further insulates an investor from specific sector downturns. For stocks, this involves investing across industries like technology, healthcare, energy, and consumer goods. For real estate, balancing residential, commercial, industrial, and retail properties ensures that performance in one sector doesn't overly impact your overall portfolio. Time-based diversification. Another layer of diversification comes from staggering investments over time. This reduces the risk of market timing and allows for adjustments based on changing conditions. For stocks, systematic investment strategies, like dollar cost averaging, spread purchases over time to mitigate the impact of market volatility. For real estate, phased acquisitions allow investors to evaluate market conditions and adapt their strategies before making additional purchases. Using financial tools for diversification. Real estate investment trusts, REITs. REITs are a unique financial tool that allows investors to gain exposure to real estate markets without direct property ownership. Benefits of REITs: provide exposure to a diverse range of properties, from office buildings to shopping malls to healthcare facilities. Offer liquidity, as they are traded on stock exchanges like regular stocks. Generate income through dividends, making them attractive for investors seeking cash flow. Exchange-traded funds, ETFs, and mutual funds. Both ETFs and mutual funds pool investments into diversified baskets of stocks, bonds, or real estate holdings. For stocks, ETFs focused on specific sectors or indices allow investors to diversify within a particular theme, such as renewable energy or large-cap growth. For real estate-focused ETFs provide exposure to a variety of REITs and real estate companies. Alternative investments. Incorporating alternative investments like commodities, private equity, or venture capital can further diversify a portfolio, although these often carry higher risks and less liquidity. The interplay between stocks and real estate in diversification. For investors seeking a truly balanced portfolio, combining stocks and real estate is a powerful strategy. These two asset classes often behave differently in response to economic conditions, providing a natural hedge against market fluctuations. Economic cycles. During economic booms, stocks may outperform as companies generate higher profits. In downturns, real estate may provide stability, particularly for properties with long-term leases and steady rental income. Inflation protection. Real estate is considered a strong hedge against inflation, as property values and rents tend to rise with inflation. Stocks in certain sectors, such as commodities or utilities, can also perform well in inflationary environments. The risks of over-diversification. While diversification is essential, over-diversification can dilute returns and complicate portfolio management. Too many investments can result in higher costs, reduced efficiency, and difficulty monitoring performance. In stocks, owning too many different stocks or ETFs may make it challenging to track individual company performance or adjust to changing market conditions. In real estate, managing a large portfolio of diverse properties across multiple markets can lead to operational inefficiencies and increased management costs. Successful diversification strikes a balance between spreading risk and maintaining focus on high-quality investments. Building a diversified portfolio. Practical steps: set clear goals, define your risk tolerance, income needs, and long-term financial objectives. Start with core investments, focus on stable, high-quality assets as the foundation of your portfolio. Expand strategically, gradually add investments to fill gaps in your portfolio's risk, sector, or geographic exposure. Monitor and adjust. Regularly review your portfolio's performance and adjust allocations as needed to align with your goals and market conditions. Conclusion: diversification. As an ongoing process, diversification is not a one-time activity but an ongoing process that requires attention, research, and adaptation. By balancing stocks and real estate, spreading investments across geographies and industries, and leveraging financial tools like REITs and ETFs, investors can build resilient portfolios capable of weathering market volatility and delivering steady growth. Whether you're a seasoned investor or just starting, mastering the art of diversification is a critical step on the path to financial success. Page 8. Chapter 8, Conclusion: Mastering the creative and analytical balance. Investment success in any field, whether commercial real estate or stock trading, requires the seamless integration of creativity and analysis. It is the ability to interpret data while envisioning potential, to see not just what is, but what could be. As we conclude this exploration into the parallels between these two asset classes, let's revisit the key principles and the ultimate goal, mastering the delicate balance between the scientific and the artistic sides of investing. The science, analytical mastery. Numbers don't lie, and for an investor, they provide the foundation for sound decision-making. Throughout this book, we've examined the critical role of metrics in evaluating opportunities. Cap rates in real estate, these measure a property's income-generating potential. Investors who can calculate and interpret this metric are better equipped to assess value and anticipate returns. Ratios in stocks, a key indicator of how much an investor is paying for $1 of earnings. This ratio sheds light on a company's valuation. But analysis isn't just about knowing the numbers, it's about contextualizing them. For instance, a high ratio might indicate overvaluation, or it might signal strong future growth. Similarly, a low cap rate might suggest stability or a lack of appreciation potential. Successful investors know how to differentiate between these interpretations by considering broader market conditions, historical trends, and comparable data. The art, creativity in action. While numbers ground an investor's strategy, creativity is the spark that identifies untapped opportunities and differentiates good decisions from great ones. Creativity in investment means seeing possibilities that others overlook. In real estate, transforming a dilapidated property into a sought-after commercial hub through renovations, zoning changes, or innovative leasing agreements. In stocks, spotting the growth potential in a disruptive technology firm before the broader market catches on. Creativity also fuels problem-solving. Markets rarely behave predictably, and unforeseen challenges are inevitable. Investors who approach setbacks with a creative mindset to pivoting strategies, reimagining asset uses, or exploring unconventional solutions are better positioned to navigate uncertainty and emerge stronger. The intuition, bridging science and art. Intuition often serves as the bridge between analysis and creativity. It is the gut feeling that drives an investor to take calculated risks, based on experience and an intrinsic understanding of the market. Intuition isn't guesswork, it is the culmination of accumulated knowledge, pattern recognition, and deep market insight. For example, a seasoned real estate investor might sense that a particular neighborhood is on the brink of gentrification, even if the data isn't fully there yet. A stock trader might recognize the early signs of an industry shift before it becomes evident in financial reports. Cultivating intuition takes time, practice, and a willingness to learn from successes and failures alike. Creating opportunities and driving growth. Investing is about more than just generating returns. At its core, it is an act of creation. In real estate, investors contribute to the development of communities by revitalizing neighborhoods and providing essential spaces for businesses and residents. In the stock market, investors fuel innovation by allocating capital to companies that push industries forward. Every investment decision, no matter how small, has a ripple effect. A savvy real estate purchase might catalyze economic growth in a struggling area. A well-timed stock trade might help a visionary entrepreneur bring transformative ideas to life. As an investor, you have the power to shape markets, support progress, and leave a lasting impact. The ongoing journey of mastery. Mastering the creative and analytical balance is not a one-time achievement, it is a lifelong pursuit. Markets evolve, tools change, and the strategies that work today may need adaptation tomorrow. To stay ahead, investors must embrace continuous learning, adaptability, and a willingness to innovate. Key habits to cultivate include lifelong learning, stay informed about new financial metrics, market trends, and investment strategies. Networking, engage with other investors to exchange insights, ideas, and experiences. Reflection, regularly review your decisions to identify strengths and areas for improvement. Final thoughts. The worlds of commercial real estate and stock trading may seem different on the surface, but they are deeply connected by the principles of value creation, risk management, and opportunity recognition. The most successful investors are those who can think analytically while acting creatively, using both data and imagination to guide their decisions. Ultimately, investing isn't just about making money, it's about building something meaningful. Whether you're transforming properties, funding groundbreaking innovations, or securing financial stability for yourself and others, every investment decision is a step toward creating a better future. By mastering the balance between creativity and analysis, you not only unlock the potential for financial success, you become a catalyst for growth and progress, one decision at a time. Page 9. Downloadable resources. Enhancing your investment toolkit. Investing requires a mix of knowledge, strategic planning, and practical tools. To help you navigate the complexities of commercial real estate and stock trading, we've compiled a set of downloadable resources. These materials are designed to provide quick access to critical information, actionable strategies, and foundational concepts to support your journey. 1. Glossary of investment terms. Understanding the language of investing is essential for effective decision-making. This comprehensive glossary demystifies key terms used in both commercial real estate and stock trading, serving as a handy reference for beginners and seasoned investors alike. Key highlights include cap rate, a metric used to assess the income-generating potential of a property, expressed as a percentage of its purchase price. Debt Service Coverage Ratio, DSCR, indicates a property's ability to cover its debt obligations, calculated as net operating income divided by total debt service. Price to Earnings, P ratio, measures how much investors are willing to pay for $1 of a company's earnings. Dividend Yield, the annual dividend income of a stock as a percentage of its current price. Occupancy Rate, the percentage of a property's units that are currently rented or occupied. This glossary is your go-to guide for clarifying unfamiliar terms, ensuring you fully understand the metrics and concepts that drive investment decisions. 2. Quick Reference Guide to Key Metrics. Numbers tell the story in both real estate and stock trading. This guide provides a succinct overview of the most critical metrics, offering quick explanations and formulas to streamline your analysis. For real estate investors, cap rate formula, net operating income, NOI, 8 purchase price, cash on cash return, annual cash flow, 8 total cash invested, loan to value ratio, LTV, mortgage amount, 8 property value. For stock traders, earnings per share, EPS, net income, 8 total outstanding shares per ratio, stock price, 8 EPS, return on equity, ROE, net income, 8 shareholders equity. The guide also includes a comparison chart illustrating the parallels between real estate and stock metrics, helping you apply insights from one field to the other. Keep it on hand to streamline your evaluations and improve your investment efficiency. 3. Actionable tips for building a diversified portfolio. Diversification is the cornerstone of risk management and long-term growth. This resource outlines actionable strategies for creating a balanced portfolio that aligns with your financial goals. Real estate diversification strategies, property type, include a mix of residential, commercial, and industrial properties. Geographic spread, invest in properties across different cities or regions to reduce exposure to local market downturns. Investment scale, balance large, stable assets with smaller, high-growth opportunities. Stock portfolio strategies, sector diversification, spread investments across industries such as technology, healthcare, and consumer goods. Market capitalization, includes stocks from companies of varying sizes, for example, large cap, mid cap, and small cap. Income and growth mix, combine dividend-paying stocks with growth-focused equities to achieve stability and capital appreciation. The guide also includes a step-by-step checklist for assessing diversification. Risk analysis templates to evaluate potential vulnerabilities in your portfolio. Suggested allocations based on different investor profiles, for example, conservative, balanced, and aggressive. How to access these resources. These downloadable resources are designed to be user-friendly and portable. Save them to your device for easy reference, print them for a physical toolkit, or integrate them into your favorite note-taking app. Included formats, PDF, optimized for printing and offline use. Interactive Excel sheets, ideal for customizing metrics and running scenarios. Infographic summaries, visual aids to reinforce key concepts. Conclusion. Equipping yourself with the right tools can significantly enhance your investment outcomes. These downloadable resources provide the foundation for deeper understanding, faster decision-making, and more strategic planning. By leveraging these materials, you'll not only improve your analytical and creative capabilities but also build confidence as you navigate the intricate world of commercial real estate and stock trading. Take advantage of these resources today and empower yourself to turn knowledge into action, one investment decision at a time.